Welcome, everyone. I'm Robert Napolitano. Welcome to Thriving Through Chaos, Conflict, and Crisis, our weekly briefing. For those of you returning, welcome back. For those of you that are new here, welcome. And we touched upon last week inflation versus CPI and how it affects you. And if you guys would like a refresher on that, please hit our website at www.gritrust.com. Many of you that are new may or may not know my history. So just give me a second. I'll give you a little brief history about who I am. I'm the founder of Grit Partners, a boutique fund management company. We focused on distressed real estate, distressed debt, and opportunistic insurance opportunities, which is just a fancy way of saying that I am the recycler of the banking and insurance industries. So I've traded, modified, and originated over $1 billion in transactions since 1998. And in the great financial crisis of 2008, I got in over my head, lost everything, went into a Chapter 13, and actually went after two of the too big to fail banks. Won two cases that I made against them and came out of the higher net worth. But the best part of that experience was actually getting a firsthand look as to how the banking and insurance industries work, how they're intertwined together, and how they set up systems for themselves for how to win, make the most amount of profit with taking the least amount of risk. So that's what I want to talk about today. My intention today is to cut through a lot of the noise and bring you facts backed by data so that I can empower people here listening here to make more informed decisions about securing your legacy and fortifying your portfolio with everything that's going on today. But in order to do that today, it requires a different type of thinking because we're in a new investing environment and what we're used to and what we're used to working in the past no longer works in this environment today. In fact, most traditional advisors react to data that's historical, it's retrospective, and that doesn't really help us. We want to see what's coming in front of us. We don't drive our cars looking in the rearview mirror. We want to know what's coming. We need to get a preview of what's to come. And so I want to bring data and information and fact to you so that I can help paint the picture as to what's coming down the road for us as investors in the landscape from a macro view to a micro view so that you can be better informed. And today, we're going to talk about a debt to GDP ratio. What does that mean? All right, let's put up a chart real quick. I want to share my screen here. Let's share the screen and I will, let's see, let's do this right here. And I want to share this screen here with you to put this up on. Okay, so this is a chart that was put together by the visual capitalists and sourced their information from the IMF, the International Monetary Fund. Before I get into what this is, and how this relates to you and what this means to you, I want to talk about real quick for those of you that, I mean, everybody knows what debt is. You should know what debt is. But GDP, not everybody knows what GDP is or what it stands for and stuff, but it's an acronym for gross domestic product. And what that means is this. Those of you that have businesses, it's your output, it's your revenues, it's how much money you're making, it's your production. Those of you that invest in stocks, it's going to be the earnings that you're looking to see these underlying companies, what they're making. And those of us that are just, individual consumers, it's the income that you bring in. So it's the number that increases our income, that increases our net worth. It's our inflows, whether it be through stock investment, through working, our jobs, or what was the other one that I just said? It was jobs, income, or your business. Sorry, the revenue in your business. So it's the income side of the balance sheet. And debt obviously is on the other side. No matter how much income we make, we're only really worth our income and value and net worth. Our net worth is really all of our value from the one side of the balance sheet, less all of our liabilities, and debt goes on the liability side. So what we're seeing here is a percentage or a debt as percentage of GDP. How much debt do these countries and these economies have with relation to how much production they make within their country? Okay, and as I said, the visual capitalists put this together, and it's a snapshot of what the country's overall balance sheet looks like. Now, the United States is the largest producer of gross domestic product in the world. And let's click on here, put some data up there. Right. So the two biggest producers of gross domestic product is going to be China and the USA, which is why you always hear in China in the news about how they are, becoming a world economic power because they have surpassed Japan as the highest economic power in the world. And then, as you can see beyond there, UK and France are just, a tenth of what the US is. So China is on the rise and been on the rise for a while, and the U.S. still has more than double of output and production in this country in the U.S. than China does. Okay, so that's a good thing to know. But what I found interesting, I went to the data, not just the chart, because the chart, yes, it shows who the biggest economies are, and that's great for first level data. But I wanted to take a deeper dive to see who actually has a better financial picture, a better financial balance sheet. So what I went to is I wanted to see exactly, what the debt to GDP ratio is here because they put it on the slide, but I went to the numbers. And if you look here, the US has 123% of debt to GDP, while China has 83%. What does that mean? Well, let's make it simple. If you had an income of $100,000, but you carried $123,000 worth of debt, are you worth anything? No, you're insolvent. You have more debt than you do income and production. If you owned a house that's worth $100,000 and you had a mortgage on it for $123,000, is the house worth anything? No, it's what we call it's upside down, it's underwater. And in 2008, people were walking away doing what they call strategic defaults, walking away when these numbers were in place, where they had more debt than value. And the same thing with the business. A business will have assets, it may have income, it may have earnings, but if it's carrying too much debt, it gets smothered and it's not worth anything. So, in the same way, we look at the US and their production and how we're being fiscally responsible or irresponsible, and we're carrying 123% of debt versus our income. Whereas China is doing a better job at managing their fiscal house, where they only have 83% encumbered. So they're doing much better than the US fiscally. Although there are things going on in China that will show you otherwise, where they're having housing collapses and they're seeing certain productions of certain industries going down as well. But that's a story for another day. But the point I wanted to make here, what does this have to do with us? What does this have to do with you and me as investors? Well, first off, I want to take this macro picture to show you where we are and what people are not talking about and why it's important to view this thing through the eyes of debt. Okay. It's important to view this because how do we handle it? See, we're going through cycles. We always go through cycles, and we're going through a debt cycle now where we're going to have to deleverage. We have too much leverage on the books, 123%. It's got to come from somewhere. And we've just heard recently in this past week that the Fed is going to pivot. And what does that mean? Well, it means that they're not going to be raising rates anymore. They may stop raising rates and may even go to lowering rates. And I'm going to say that in 2024, you're going to see a lot of the interest rate, the Fed funds interest rate getting lower. And here's the reason why. Because when you go through a deleveraging cycle, part of the cycle, there's only four things you can actually do in order to deleverage, whether it be on a macroeconomic level or a personal level or through your business. There's only four things you can actually do. You can lower your spending, you can restructure your debt, you can print more money, or sorry, the fourth thing was it was printing money, it was or taxes. That's the other thing. So it's either from the economics point of view, it's either going to be stop spending or lower your spending, tax, print more money, or debt restructuring. Now, let's go through that a second. We know politicians are not going to stop spending. They want to stay in place. They want to keep their constituents happy. And so they just need to print more money because they're not going to stop spending. Well, that's actually the second point. They're not going to stop spending, which means that the Fed is going to have to print more money. So in order for them to print more money, and the cost of that money has to come down, which is going to cause them to lower interest rates. If they lower the interest rates, the new money that they're going to be printing in 2024 will come at a less of a cost. And so they say we can stretch this out a little bit further. Now, there's another reason why I say that we're going to lower interest rates in 2024 is because we're going into an election cycle. And so it's important for certain platitudes to be put out there as narratives in the next 8 to 12 months. So you're going to see certain platitudes about how the economy is doing great, stock market is doing well, and this is going to be a stimulus for that. When the Fed rates go down, money becomes cheap. A lot of these companies are going to take in cheap money, do a lot of stock buybacks, inflating their prices uh, um, due to low interest rates and due to debt. It's going to be a debt fueled price increase, not a value fueled price increase. It's not an increase in value. It's going to be an increase in the price, which then they're going to say, well, the headlines are going to be, oh, the stock market's going up, economy is doing great, and so we should all continue on the path that we're going. You're going to see those narratives coming down the road. Don't believe any of it because it's all debt fueled. It's not real based on production, because that's what matters is when it's based on production. So you're going to see more debt and inflation. And what will happen is we have, click over here, I have it here now too. Globally, there's a total of $11 trillion in corporate debt, and it was rated by S&P Global, and it's set to mature in the next 24 months. And almost half of that, 45% of that corporate debt is in the US. And what does that mean? That means it's coming to maturity and they're going to have to reissue new debt at new interest rates. And so in order for that to be sustainable over the long term, Fed is going to have to lower those interest rates because a lot of these refinancing are going to come in place in the next 24 months. Lowering the interest rate, cheaper money, more money into the economy. And that means there's going to have to be a way to pay for all this. And we all know that printing more money with lower interest rates just means pricing and inflation goes up. So we're going to end up paying for all this. So we're going to see a lot more inflation, price increase while interest rates come down. The corporates will restructure their own debt and the corporates will be fine. And the stock market will go up. And the narratives will be there just so we get to the end of an election cycle. And then what's going to happen then? It remains to be seen. But that's where they're going to push the cliff out to for the next 8 to 12 months. Okay. But with all that, that creates opportunity. That's the chaos that's going to come. But I want to give you some perspective first. What does this 11 trillion mean? By way of perspective, the great financial crisis of 2008 was fueled by housing mortgages, mostly by subprime. But the mortgage debt balance back then was 11.3 trillion. And look at the calamity and the collapse that we had back then. Right now, we're at 11.8 globally, not just in the country, globally. As we sit here today, there are trade routes that are being attacked in the Red Sea that has to do with supply chains, which means our goods and services are going to have a slowdown again, which means there's going to be less goods and services. There's going to be less products for us to buy because of these constraints, which means pricing is going to go up on the products again. Prices up, prices up, prices up, prices up. It all has to do with all this. But I don't want to stay on this doom and gloom all the time because there are opportunities here. Let me show you this as well. When they refinance, I put this up on purpose. I mean, it's kind of off topic, but it does relate here. That central banks around the world know that the US dollar is becoming less attractive and have all but abandoned it. What does that mean? See, when corporates get refinanced, when government debt gets refinanced and they issue new debts, new bonds, new used treasury bills, okay, there are investors on the other side that buy that stuff. Most of the investors on the government side are foreign. But what happens when those foreign investors don't like the value of our dollar anymore because they see what I'm talking about here? That as more dollars go into the monetary system, it lowers the value of that dollar. And so it doesn't become a good investment. Well, this chart here shows you the central banks since 2022, I'm sorry, since 2021. That red line going down shows you how they've abandoned investing in the US Treasury, the US dollars, and the debt of this country, the IOUs of this country. And where they've gone is they've amped up their purchases on gold, a real hard asset, which, by the way, throughout all this has been making a run for value. So look at what the central banks are doing. They're dumping the US dollar, going for gold, because they see this stuff coming. And as I always say, you want to see what the banks are doing, watch what the banks are doing, especially from up high, and you want to plan and do accordingly. So in the midst of all this, while all these bankers are leaving and they're dropping the dollar, and you're going to see a lot of players exit corporates and US treasuries, and you're going to see a lot of this stuff. It's going to create a lot of calamity. But when the party is over and all the party goers leave, it's time for the cleanup crew to come in. Bloomberg just put out an article probably about a week ago saying that private credit has given investors the best returns, even better than private equity. And so my point of this is while all this calamity is coming, and it's coming, and it's going to leave a mess behind, that in this chaos and this crisis and all this confusion, there's opportunity. And so I like to have these weekly briefings because I feel it's important for people to be informed given this climate. Again, we're facing this chaos, the conflict and crisis in the world, and that only creates complexity, confusion. And so I want to try to deliver some clarity so that you can make some informed decisions, do the one thing that we're all trying to do, which is to expand and protect our legacy. And so that's the reason why I come here every Tuesday at 1 p.m. You're welcome to come back because you need the facts to be informed so that you can effectively seize these opportunities as they present themselves. So just think of this as advancing your personal legacy and protecting your personal legacy as a result of someone else's incompetence. And we can all agree that incompetence is pervasive in the world today. So here's to your greatest days of success in front of you. I wish you all a prosperous day. And until next time, I'm Rob Napolitano, and we will see you next time. Thanks for stopping by.